Okay, in this video, I'm gonna try to teach you how to. I can't believe I keep trying. I can't believe I keep saying I'm gonna try to teach you. I am gonna teach you. Anyway, okay, so here's the deal. Of all the things that we are setting out to learn in this entire course, this lecture is going to be the hardest, okay? This is historically the most difficult concept in the book. So if you feel like um, you're not understanding this, like you're not alone. It's a very common feeling. And I poked through the PowerPoint slides, and the PowerPoint slides um, are woefully inadequate. So again, I think it's not unreasonable to assume that this might be a difficult lecture. And with that said, if you sort of you can approach it two ways. You could try to understand what's happening. You can try to figure it out, and I would encourage you to do that. But if you don't want to, and you just want to like sort of hold on to some formulas and go through the mechanics, you can certainly do that. And I'll point to those instances where I'll say like these are the steps you want to take, and if you just do this, you'll be okay. All right, so we're going to try to figure out the price of a bond, the issue price of a bond, okay? And what we want to think about are two things. We want to figure out, okay, here's the deal. Listen, I am going to, right, if I'm the company and I'm selling a bond, I am promising to pay my investors a semi-annual interest payment. And so in this particular example, we're saying, hey, listen, every 6 months, we are going to pay an investor $4,000 for the next 2 years. Okay. And what we're really trying to figure out is this red circle is in return, right? So if I'm going to pay somebody $4,000 every 6 months, what would somebody be willing to pay me today? Right. And so if you think about the present value or the time value of money conversation that we were having, we're saying, hey, listen, if I'm going to tell you that I'm going to pay you 4,000 6 months from now, we know now that that isn't worth 4,000 today. Because again, if I had something today and I put it in the stock market 6 months from now, it would hopefully be a little bit worth a little bit more. Okay, so that's step one. We have to figure out what is the present value or what is the issue price associated with all the interest payments that I'm making. And then the second component of the bond is, right, the face value that we promised to pay at the end of the bond's maturity, right? So in this particular instance, we're going to pay our share or our investors $100,000 at the end of 2 years. And therefore, what is that $100,000 worth today? And if you didn't watch the time value money lecture, which is the lecture just before this, I would really encourage you to go watch that now because it'll make this, what we're talking about, will make much more sense. Okay. So when we try to figure out the value of a bond, we need to figure out two things: the value of the interest payments and then the value of the face value of the bond. Okay. So let's look at the example that the book is giving us. All right, so in this video, right, the in this example, the par value or the face value is 100,000. We're going to try to figure out how much somebody would be willing to pay if the stated rate was 8%. The market rate, why the fuck do they do that? The market interest rate is 10.031%. We're going to pay interest on June 30th, December 31st. We're going to issue it on December 31st, 2021, and it's going to be mature in 2 years. So before I start doing anything, I'm going to like really look at the stated rate as opposed to the market rate. Okay. So the stated rate is 8%. And the market rate is essentially 10%. And so we were saying, I think in a previous video, that if the stated rate is less than the market rate, then we're going to issue it at a discount, right? If everybody else is doing something much better than what we're doing, we have to lower the value of our bond. Okay. And so I'm basically saying this circle, what we're trying to figure out, it's going to have to be less than 100,000. And if it's not less than 100,000, then I think maybe we've done it incorrectly. Okay. So I could point to this slide, but this slide makes my fucking head hurt. So I am going to instead use my chalkboard. Okay. So I said we are going to determine the present value of a bond or the issue price of a bond based on two things. The first one is the interest payments. Okay. So I'm just going to focus on that right now. So the first thing we have to do is we have to figure out what are the interest payments. And the interest payments are going to be the face value of the bond times the stated rate. And I think from the slide that we were just looking at, we were saying the face value is 100,000, and then the stated rate, the rate that we promised to pay our investors, was 8%, but we're paying semi-annually. So therefore, it's really 4% twice a year. And therefore, we are going to pay $4,000 twice a year for 2 years. Okay? That's step one. Now, I need to figure out what is that worth? Okay? So I need to figure out I'm just going to call it a present value. I'm abbreviating here, but present value factor. Okay. I'm going to multiply my 4,000 times a present value factor. Okay. Now I'm going to go back to the slide. Don't panic. And I've got two tables here. I've got the present value of a dollar, and then I have the present value of an annuity. Okay. An annuity, the second table, an annuity is an equal payment over a set number of periods. And if you think about our interest payment, that is an equal payment of $4,000 4 times or twice a year for 2 years. So that meets the definition of an annuity. So when I'm trying to find the present value factor to figure out if I'm going to pay somebody $4,000 every 6 months for 2 years, what is somebody going to be willing to pay me? I'm going to multiply that 4,000 times the present value factor of an annuity. Okay. So the first step is trying to figure out the right table. And so I'm just going to say, when I'm trying to figure out the present value of the interest payments, I'm using the annuity table. Okay. And then what I want to do is I want to find the number of periods. And again, it's 2 years, but we're paying semi-annually. So the number of periods is 4. And then I need to find the rate. And every time I use the rate, I'm always looking for the market rate, right? When I'm trying to find the right present value factor, I'm always looking for the right rate using the market rate. And we said the market rate is 10.031, but we're paying semi-annually. So it's more like 10.0016 or somewhere in there. So 5.0, it's probably this right here. Not probably, it definitely is. Okay. And therefore, this is what I'm going to use. I am going to use 3.5449. That is the market interest rate of 10% divided by 2 because we're paying twice a year, and it's the market rate, and then it's the number of periods. So I'm now going to take my 3.5449, 3.5449 times my present value. Okay, I did the math and I'm coming up with 14,100. I'm just going to round it to 180. And let's just make sure that, yeah, 14,180, the $4,000 interest payment. So the stupid slide from the book, I think we're consistent. Okay, now I need to figure out again what the present value or what the issue price is associated with that face value that I'm going to pay all the way at the end of 2 years. So the next one is the face value. And in this one, we already know the face value is 100,000. So I would do the face value 100,000. And then I'm going to multiply that by the present value factor. And so I'm going to go back to the tables that our PowerPoint slides we're getting. And look, it's not an annuity, right? Because we're only getting the 100,000 one time, right? There's 4 periods. And so it's 0, 0, 0, and then at the end it's 100,000. So that's not an annuity. Instead, what that is it's the present value of $1. Okay. And just like, so I'm going to use this table for the face value or the par value. Okay. And just like we were doing a minute ago, we're going to use the market rate, and the market rate was 10.036 or 35. We're going to chop that in half because we're paying semi-annually twice a year. The bond was a 2-year bond, paid semi-annually, so twice a year. So 2 years, twice a year, 4 periods. Okay. So now I'm going to take this 0.8222 and multiply that by my face value times 0.8222. And I think that is 82,220. And now I think I can combine these, right? So now the face value is the combination of both 82,220 plus 14,180 is 96,000. I'm just going to round up 400. 96,400. And I'm feeling that like that might be right because again we were saying we're going to issue it at a discount, and since I'm issuing it at a discount, right, it's going to be less than the face value. So we can just go check our answers to make sure. Yeah, 96,400. Right? Just down here. I don't know. I personally like drawing on shit. I draw on the chalkboard, I draw on the PowerPoint slides. For me, it helps me explain things. I could have tried to regurgitate this PowerPoint slide, but to me, I think we all would have gotten totally confused. All right. Now, the next slide is going to walk through an example where we're determining the present value of a bond, but it's going to be issued at a premium. Okay. And so I think it's all the same steps. The only thing that's different, since we are offering it at a premium, the stated rate has to be greater than the market rate. And so I think if you were to like spend a little bit of time looking at this slide, we would be fine. But whether it's a discount or a premium, it's the same mechanics, right? It's the same mechanics. You want to figure out what the present value of the annuity is, and you use the market rate and the number of periods using the annuity table or for the interest payments. And then when you want to figure out what the face value of the bond is, or what the present value of the face value of the bond is, you use this $1 table. And again, you use the market rate and the number of periods, but it all should work out the same.